Welcome back to Introduction to the Financial Services Industry. This is going to be a short video to introduce you to corporate actions and what that's all about. Again, a disclaimer, this is really just an introduction. So corporate actions, lots of different types of corporate actions. So any event that brings material changes to a company and affects the stakeholders. This includes shareholders of both common and preferred stock and bondholders. That's a corporate action. These events are generally approved by the company's board of directors. Shareholders are permitted to vote on some of these events as well. So there's some examples I have here of corporate actions. And again, brokers, when these types of significant events happen, when a company does these sorts of changes and it affects their stock or their preferred stock or their bonds, brokers are obligated to notify their customers who hold these assets that these corporate action events have transpired. So some of the examples here are corporate reorganization, splits, stock splits. You'll hear about all the time. Where there's a split, where there's a reverse split. It could be a merger. Maybe the company is merging with another company, or it could be an acquisition where they're acquiring somebody, or maybe they're taking a division of the company and they're spinning it off and issuing a separate stock for that spin-off. Or maybe they're changing a name. Maybe they're changing the symbol that they trade on, or the exchange that they trade on, or the name of the company. Maybe they're changing their primary exchange that they trade on as a stock. Maybe it's something about dividend payments. Maybe they're making a dividend payment. Maybe they're making interest payments. Maybe there's what's called voluntary tender offers, and I'm going to talk about that in a minute. Or rights offerings, which, if you remember in the equity section, we talk about rights, what they are, or convertible securities or warrants. So all these type of events that happen where the board of directors of the company have decided to do something, and it's a material announcement that could affect the value of the assets, brokers are obligated to notify their customers who hold these assets, who hold a bond issued by the company, or a stock or a preferred stock issued by the company. Because obviously, if a company is changing their name, or they're changing the symbol that they trade under, or they're merging with another company, or they're acquiring another company, or maybe they're taking a division and they're spinning it off, and it's going to be its own wholly owned subsidiary, or maybe it's going to be an independent company with its own stock. All these things affect the underlying value of the asset, whether it's a bond, preferred, or a stock. So when these events take place, they're called corporate actions, and brokers are obligated to notify customers when these things happen. Now, some examples I have here. One is, I mentioned earlier, is the split. You'll hear a lot about this. There's two types of splits. There's splits and reverse splits. So the first example is a company decides to split their shares 2 for 1, leaving shareholders with twice as many shares as before. So let's say if there's a 2 for 1 split and you held 100 shares of this stock, right? And the split was declared. After the split happens, instead of owning 100 shares of the stock, you now own 200 shares. And what will happen here is, if you owned 100 shares at $50 a share, the day after the split, you own 200 shares at $25 a share. Your net value didn't change, just the number of shares that you held changed. Same thing with a reverse split. Maybe the firm decides for every 10 shares of stock they have, they want to consolidate down to one share. And that happens sometimes when you have penny stocks, where maybe someone has a stock that sells for 50 cents a share. And what they'll do is they'll do a reverse split. So they'd rather have one share worth $5 than 10 shares worth 50 cents each. So there's splits, which is, let's say, a 2-for-1 split. You get 2 shares for every 1 share that you own. And there's reverse splits that goes the opposite direction. For every 1 share you own, maybe for every 2 shares you own, you get 1. Either way, these splits affect the value, the underlying value, and the investor has to be aware of them. And there's lots of reasons why corporations will want to do this. They want to make maybe they feel the stock is too expensive. Maybe the stock is selling for $300 a share, and they want to attract investors who maybe otherwise would be scared for $300 a share. They'd be scared to buy the stock. But maybe at $50 a share, they'd buy it. So what they'll do is they'll do a split so that the stock appears more affordable. So that's splits. That's very common. Now then there's another type of corporate event that affects bondholders, where, for example, if interest rates fall sharply, a company may decide to call their bonds. And that's callability. Now, we talked about this earlier. Let's say a corporation has bonds out there, and the bonds are paying, the company is paying on the bond 8% on the bonds. And maybe interest rates fall. The corporation may decide to call those bonds back in and pay them off, settle them, pay the bondholders up to that date, and then they'll go out and they'll issue new bonds at 6% or 5%. So the idea is, if you've got bonds outstanding and the bonds were created with callability, they're allowed to be called, and interest rates drop, so the bond is the company is borrowing money at a high rate, and the interest rates drop, the corporation can call those bonds back in, pay them off, settle them up to that date, and then borrow the money in other ways. So that obviously that would affect the bondholders, because they're going to get paid off, they're going to get settled out. There's another type of corporate action, which is called a voluntary corporate actions. So some type of corporate actions just happen. They're involuntary. Like the corporation changes their name, or they declare a dividend, or they change their symbol, or they change what exchange is their primary exchange. Those things are all involuntary. But sometimes corporations will do what's called a voluntary corporate action. And what they'll do is, through their brokers, through the registry, they will notify all of the current shareholders and say, hey, we've got a voluntary action. You can do this or you can do that. And they'll also be able to say, if you don't respond to the voluntary action, something will happen automatically. So what will happen is brokers will be notified that these voluntary corporate actions are happening. And it's the broker's responsibility to notify all of their clients who have these assets to respond, to make a decision on how they should respond to voluntary corporate actions. So an example might be a tender offer. Maybe there's been a tender offer out and all the shareholders are being offered some offer, and that they can either accept or deny it, accept it or turn it down. Or maybe it could be some type of merger. Maybe there's a merger offer out there, or there's an optional dividends offered, or there's they're asking for voluntary corporate actions on a bond consent, or odd lot tender offers. These are cases where the shareholders or the asset holders are going to be contacted about these voluntary events and asked, what do you want to do? Do you want to do this? Or do you want to do that? Maybe there's an offer where there's a offer out there that you can get shares, or you can get cash, or you can get these shares, or you can get this, maybe this class B of share, or there's a lot of these. They're very complicated. I can't go through every possible contingency, but the point here is it's a voluntary action that the corporation is asking the shareholders, okay, you've got these options, what do you want to do? And the brokers get notified of these, and the brokers will contact their customers who hold these assets. Those are voluntary corporate actions. Now, I just brought up this slide, and if you sat through all the equity discussions, you probably saw this example. I like to use Google as an example of a corporate action, because there's a couple of things going on here. Google actually changed the name of their company. So the board of directors of Google said, we're going to change the name of our company. We're now going to be called Alphabet Incorporated. Well, that was a corporate action. So what they had to do is came out with this announcement. It was a corporate action. They had to notify everyone, and all the asset holders had to be notified that the issuer is now a new company name. The name of the company is now Alphabet. And you'll see this from time to time. Facebook just recently did the same thing. If you notice, Facebook changed their corporate name to, I forget what they changed it to, but they changed it. So the name, a corporate name change of the issuer, the security, that's a corporate action. And the other things that Facebook did, not Facebook, that Google did was, at one point, they also changed their symbols. They changed which symbol was the A issue or the C issue. They came out with actually, it was really what they did was they came out with the C issue. So Google trades under two different symbols on the NASDAQ exchange. And what they did was they came out with a new stock to trade on the exchange, and it was a C issue. And the thing with the C issue is the C issue doesn't have any voting rights. So when they came out with that new issue, when they flowed that new issue, that was a corporate action. And they did some funny stuff where they changed around the names of GOOG as a symbol and GOOGL. And I'm not going to go into that here, but they did a little bit of a flip on the name, which I think caused some confusion. But the point is, there's an A issue of Google that is traded on the NASDAQ under the symbol GOOGL, and that's an A issue that has voting rights. And then they also trade on the same exchange. Google also trades as GOOG, which is the C issue of the common stock that trades with no voting rights. And then separately from this, there's just a note here that notes that there's also a B issue of Google stock that's not traded publicly. It's not traded on the exchange. It's not traded on any of the public markets. It's held privately by the founders and a few of the other directors. And the B issue, for every one share, each one share has 10 votes. So normally you have one vote for one share. In this case, the B issue has 10 votes for one share. So, and obviously this is all done so that the founders can exert control over the management, over the future of the company. Because remember, it's the shareholders that elect the board, and the board is the one who hires the management of the company and makes some major decisions. As a board that comes out with like these type of corporate actions. So I hope that it wasn't too confusing. That was a quickie introduction to corporate actions. There's a lot of different corporate actions between splits, name changes, and other things. If you have any questions, please contact me. I'd be happy to hear from you. Thank you very much.